So our compliance team is a little skittish, so we took a while to get this across, and it won't really be available on the app. However, if you're interested in it, you can reach out directly to my colleague, Jason Miner over here, and I'll repeat that at the end. I guess while I wait for this, I found your question to be fairly interesting, so I'll just address it really quickly. There is a problem around artificial intelligence right now. It's not a problem, it's just a natural evolution around the technology and the development there. Essentially, it's a problem around what's called transfer knowledge and catastrophic forgetting. What happens is that as a machine learning algorithm, artificial intelligence does not yet exist. It's machine learning. Machines can learn things in a very similar manner that we do. However, as they learn one thing, they overwrite whatever it is that they learned before. There's not right now the ability to transfer the learnings from one silo over to the next. That's really generalized artificial intelligence. It does not exist yet. When you look at Google DeepMind and their ability to beat the world champion in chess, checkers, Go, which I would say Go has some qualitative aspects towards that, as well as some game theory, more importantly, Texas Hold'em and poker. That is not the same algorithm of instantiation of Go. They have all been trained specifically on that problem, even the ones that have been trained without actually knowing the rules around there. I'll tell you when it will happen. Whenever you see that consecutively the Go, and I think that the people at DeepMind are doing tremendous work, I read every paper that they publish, when you see consecutively in one day that the algorithm goes and beats the world champion in chess, checkers, and all these other games, and then circles back the next day without any other training and is again able to beat them, then we have approached generalized artificial intelligence, and everybody in this room will be out of a job. Okay.
How much time?
So I think I have...
No, how many years?
Before we get there. So I tend to think of my life, and this is the difference of my life pre-becoming a technologist versus post, is I now no longer worry about kind of those types of questions. What I pay attention to is what is the inflection point, what's the second derivative of the rate of change, and be prepared to capture that. It will happen, I have no idea, but I'm telling you what to watch out for. And then when that occurs, that's where we are. I think we're probably somewhere between 5 to 10 years away from that actually occurring, but it may be longer. Okay, so with that, my name is Michael Beal. It's a pleasure to be here. I am the CEO and co-founder of Data Capital Management. We are a machine learning, as I said, artificial intelligence doesn't yet exist, but very similar to Quantamental. I had the idea before Quantamental became a term, so I pay attention to what people are understanding it, and I will adapt and meld to how people will understand what we're talking about. So we'll call ourselves an artificial intelligence hedge fund. We're based in New York City. We manage the DCM AI Absolute Return Fund, which is focused on US equities at the moment, and as you'll see, we'll talk a little bit more about that. That's largely because the data is richest here. It's built extensively, and eventually we'll move over to other asset classes and geographies. As long as it's electronically traded, my machines can't yet pick up the phone and argue with somebody on the broker side. I leave my CTO to do that. So, in any context, we've been around since 2014, and as you'll see here, actually, I thought that your comments, UN, were really spot on, and I'm excited around that, and you'll see very similarities, and hopefully I'll be able to build on some of the concepts that she brought up here. Our focus is not about DCM. We will talk about it, but that's the benefit of being able to create your own company. It's really just my vision, and we've been able to build it. So as I reference DCM, it's really just larger, the topic, where are we heading, what is quantamental investing, and the likes. So what is the future of artificial intelligence and its application to quantamental investing? So to understand that, you have to back up. Up until 2009, I was just a regular discretionary, fundamentally trained investor, Harvard, Morgan Stanley, TPG, and kind of those general levels of training. And then in 2009, I was living in the Bay Area. I was also splitting time between Hong Kong, and I just had a vision for this data economy, thinking that eventually machines were going to put me out of business. By the time I got to the stage where I could launch my own fund, there would no longer be an opportunity. And I was young enough at the time to say, rather than be disrupted, I'm going to go about disrupting the industry. I was very fortunate to be able to co-found the Big Data and Machine Learning Group for JP Morgan, meet some of the most brilliant data scientists and quant researchers in the world, and convince them, or they convinced me, that we would come together and launch Data Capital Management back in 2014. And this really was the vision around it, which was that For me, and we'll talk a little about what quantamental investing means, is I'm frankly as confused as all the rest of you are, but hopefully this will add some context to it. For me, what it is that as a human, I am focused on future free cash flows. I'm focused on trying to understand what happens, what caused a price movement. I really don't care that a price movement occurred, which is what quants traditionally are caring about. 2 standard deviation move, how many times has it occurred, is it statistically significant, is it going to mean revert, etc. I really don't care. What I want to know is what caused that. And I think that gets to some of the things that Professor Lev was talking about, as well as what you were talking about in terms of quants picking up actually on just terrible companies, because they don't have the ability to look on the free cash flow. So we use artificial intelligence, big data, and all those other things to really do one simple thing: to create AI traders, as we call them, that are trained to invest in a way that humans can, but can be more scalable, not take bathroom breaks, and be able to monitor across a variety of different data streams, integrate them in real time, and then be able to automatically take action upon them. In order to do that, we had to spend 2.5 years building an entirely new architecture, and we'll talk a little bit more about why that is. But this is what Quantamental means to me: actually bridging and bringing together fundamental investing styles and the deep bottoms-up diligence that we are all accustomed to with quantitative and statistical rigor. However, that's not really what quantamental investing is at this current stage, at least as far as I can understand, and you've confirmed this for me. Really all it is applying a few fundamental factors as filters, and then applying that either to nothing and just doing a long short associated with high price to sale or versus low price to sales, or adding on a momentum factor or a couple of other traditional quantitative techniques. And importantly, what I'll highlight here is that then tends to lead itself into some form of French construction. Sometimes it's a larger cross-sectional arbitrage. But the only thing, and what I would like to talk about here, that is stopping, in my opinion, Quantamental from going from quant to really this meld, is the discounted cash flow analysis, right? There are no, maybe it's a very simple DCF, but it's kind of a perpetual growth rate off of whatever the current earnings are, which, as Professor Lev mentioned, doesn't really mean much. But the rest of that stuff, given the accounting metrics, it's pretty simple, pretty straightforward, and it's not hard for any quant to just add some filtering to then get their universe defined. So what is required in order for us to really head into the world of true melding of quantitative and fundamental investment strategies? It's a view on future cash flows. And that's essentially everything that Professor Lev was talking about: the value of the intangible assets, the value of your property. It's a function as to what do you believe is going to happen in the future. And that's really the problem that is breaking us down. And as Warren Buffett and Charlie Munger mentioned, the actual discount rate that you apply, that doesn't matter, right? Everybody has different costs of capital, different opportunity costs. Just using the risk-free, and if you really are a value-based investor, then you should just look at the risk-free rate and then look at a discount to that. So it has nothing to do with what's your actual discount rate or how long you're projecting it out. It has to do with what is your viewpoint of future free cash flows, what's your conviction associated with that. And unless you're convinced and you've done the work, as I heard earlier in the gold, well, then you can't actually ride through taking a short position on something that could have unlimited downside protection around that. You actually have to do the deep work to have some conviction associated with your future free cash flows around it. So why is it that quants haven't done it? Seems pretty simple. Well, the problem is that the benefit, and this really speaks to me, I found the cartoon after I really wrote what I was looking for. It's amazing what you can do in Google, right? Just put in a couple of words that you want and up pops it up. Why should that be any different in the capital markets investing environment? Food for thought. The reason that most quants are not really interested in that approach is because future projections rely on something called human intuition. And we know that human intuition is fraught with fraught with bias, and it's impossible to really test that. As you mentioned, you were doing 2012 just off the models because you couldn't try to look back and say what the humans would do, because you're obviously going to introduce forward-looking bias. And as anybody who's done quantitative or systematic investing knows, if you do something with forward-looking bias or any kind of bias versus variance trade-off and you're not as robust around that, the first thing is that when you put that into the market, you're just going to be very sad and likely fired. So in that That's really the way it does it. But this is really what gave me the initial idea around data capital management. I was there during 2009, 2008 really, coming out of the financial crisis, and we were trying to figure out what are we going to do? Where is the world going to go? And our chief investment officer kept making analogies, and I worked pretty closely with him, towards the Japan crisis. And it turns out that he's right. We can look at the world right now with the banks and the fact that the yield curve, regardless of what the Federal Reserve tries to do, it's not increasing on the long end. But I looked at it as, well, that's intuition, and I don't know how to trust that. I don't know how to deal with that. And if you're right, fine, you're only, I should listen to you because you're a senior, but you're only senior because you've tended to be right, so that has confirmation and survivorship bias associated with it. So if you are correct, then there must be data to support what you are talking about. And so internally at Data Capital Management, we named our system DCM Intuition to make it clear that I don't care about anybody's intuition other than our systems. But the challenge is, how can we get our system to have intuition around factors and pieces of information that are not purely quantitative and would be more qualitative in that iframe? So what is the answer? Well, the answer is big data. And for me, that's where big data and alternative data or novel data, whatever you want to call it, that's where it becomes interesting. Because now we are being provided and have the ability to ascertain some level of a historical consistency of the types of information sources that humans were traditionally the only ones who had access to, and have largely lost access to that as a result of Reg FD. And now you have to go back and see that if I were standing in that moment, would I be able to project forward and to build up that intuition in a manner that can actually be statistically sound and validated, very similar to the rest of the quantitative industry. And just as a simple example here, one of the other things that drove me crazy and led me to this data capital management path back in 2009 was actually being asked to go stand in front of parking lots and count how many people were going in. And then I would change that in terms of some level of an approximation, have some level of an multiplier effect to scale beyond the San Francisco Bay Area to the rest of the country, then have my function of foot traffic, average revenue per user. I was also doing some more subscription-based, so that's probably not the right term, plus an epsilon, which then leads into a function of, if you can have a viewpoint of future sales based off of foot traffic, now you can have some viewpoint of share price, because the future sales are a function of, or the share price is a function of future sales, margin, plus some other noise factor. And now the difference is that you can do the exact same things, right? Except now that's available in a machine-readable format, right? There's satellites floating around 24/7. They're taking pictures in any given geography from 11 to 1, and luckily there's a pretty large corpus associated with that. And you can do the exact same work, now taking out the intuition or the human kind of gut feeling that we've all felt so proud of, and replace it with the same problem to be solved, but in a more statistically robust manner, for which people with PhDs versus MBAs tend to more respect. But the problem with all of this alternative data is that it's growing too fast. It's too big. Everything that I heard Professor Lev say, for example, the earnings and consensus, makes exact sense, because Wall Street research consensus is ridiculous. It doesn't mean anything. That's actually the problem. There are new companies out there. If you don't know of Estimize, I'd suggest that you go take a look at that, right? But they're doing crowdsourced versions of earnings estimates, collecting all of these viewpoints around there, and actually if you do the analysis, you'd see a very different result, that the crowd version of the earnings projection, it tends to be about 15 to 20% off of where Wall Street consensus is, and that actually that beat versus the Wall Street consensus beat actually still does have some statistical power towards it. Again, that's not actually in my best interest to tell you that, but this is more about the data economy and where I see the world going, and I want you all to participate. So that's really the problem that all this alternative data has created. There's so much information now that it doesn't matter about auditing. For me, it's about getting down to the truth and the source, get closer to the pipe, and therefore you can do your own information, own analysis of pipelines and the likes. So yeah, it comes with its own challenges. You have to be able to build out. That's why I'm a little bit more comfortable speaking, because I don't think that people are willing to spend the 3 years of pain that we did to build out the types of architectures required to do the types of things that we do. And it also requires machine learning, right? We have a very similar process to which you laid out, except for we rely on artificial intelligence to identify what seems to really matter, and the word that I was talking about in terms of what really matters for a financial services company versus a healthcare company. We then have a human overlay on top of that to kind of see if it makes sense. But also, if it's really just being constricted to only the things that make intuitive sense to a human, why would we have invested in all of the underlying architecture? Some of the things, I want to see the yield curve when it comes to a bank, but I am looking for some of the things that are somewhat unexpected. And it's very important that you can build and meld a culture that brings together MBAs and PhDs, because as this graph here from JP Morgan shows, each one of these alphabet soups of machine learning algorithms will come to very different answers under very different contexts, and that's one of the problems. You don't have the ability to know what is the right approach for the right problem and then transfer that learning over to another. But if you are able to kind of overcome all of these things and you're able to look at what is the right type of alternative data, put that into a viewpoint that you can look at free cash flows and future projections and identify that for certain companies, their intangible assets seem to really matter. For other companies, their free cash flows and CapEx seem to matter. And then from there, narrow down and hone. Well, then you can get into this new world that I really deem quantamental, right? Of having a viewpoint towards the fundamental factors, which give you a viewpoint of company earnings forecasts, time that over with the market valuation forecasts and current conditions, and then have a more long-term buy, hold, sell. But then the other thing, as a newer fund, I can't wait forever, right? I'm sure that 6x return on gold will be great whenever it occurs. But if I blow up in between, who cares, right? So for us, it's more about when is the right time? Why is now the right time? Which is where we tie in a lot of the new information sources. But even on just taking the left side of this and not being able to have the fully systematic execution that we have, even that will add real value and move us from just filtering to a more bottoms-up, forward-looking viewpoint around where the world is going. And it's all worth it, and it keeps us motivated internally as a team, because I think that there's something very interesting, and let's see if this does what I think it does. It does, good. Right? Mr. Graham mentioned something. Relatively few, easy to understand, and we'll say that we're all more than reasonably intelligent, so we'll say that it doesn't have to be easy to understand. But still, there is limited mental capacity and limited attention of humans. Right? So the whole vision is to be able to have thousands of these artificial intelligence traders, thousands of Benjamin Grahams, all individually understanding what seems to really matter, being able to monitor that information. Now, it takes a long time to build these, but then once you've built it, and it took us 4 years to do such, now you have an army of these little traders that are working 24/7. And hopefully we can maintain them, continue to have great value propositions around that. But through that melding of the quantitative approaches, which are really just about statistical rigor and process, with the beauty of fundamental investing, which is deep diligence, a viewpoint as to the future, that is the future of quantamental investing. But it does require both big data, which is a function of alternative data, which you should just think of as information that previously was only the purview of humans, and artificial intelligence, such that you can actually take action and be able to look at this whole huge sea of information and narrow that down to what seems to really matter, and then in our context, set up AI traders to monitor for the conditions and perfect conditions. I believe in your gold thesis, but I would feel much better when I have some viewpoint that something is going to change that will allow us to have some inflation. Right? Then I would allow one of our AI traders, or I would want to take action upon that. So with that, I thank you very much. If you'd like to have a copy of the slides, you can reach out to my colleague Jason Miner at j.miner at Data Capital Management. Thank you.
I think we probably had to have time for one or two questions. I know we're running a little bit late. Here's one right over there.
Yeah, so Bloomberg reported that Steve Cohen was trying to do something very similar at SAC/Point72, where he's trying to get machines to act like humans, and you're on a very high level are trying to do the same thing. So in his environment, he has a set of very proven humans that have been proven to be very good at trading and investing. You have a set of people who you don't have that long-term track record internally. So how do you think about the idea of creating the learning environments for the machines in your new organization?
So I'm not sure I fully understand your question because you focus on the track record associated with that. So first statement, I think what Point72 is doing, I have tremendous respect for the organization across all parts of it. They're not really applying it on the quantitative side of it, which is Cubist, but more so on the fundamental side. In that world, what they're really doing, if you just think about it, is that they have replaced and smartly replaced the analyst role. Right? Rather than having analysts like me when I was coming out of school, they have analysts like my co-founders that are data scientists. Those data scientists then provide insights to discretionary trained investors, and then the PMs can do with that as they so choose. And a very interesting article in Bloomberg maybe a year and a half ago about the culture shock that is occurring within that organization in particular, but is mirrored across a lot of others. First statement. Second statement, I won't focus on a competitive advantage, but the focus is not about, it's about amassing the information. I struggle from a systematic component with some of the new data sources, and I think that they're better suited for people like Point72 because they have a very short history. Year and a half, I can't do anything with that. I can't train a machine learning algorithm on that. However, a human who can look at it and say, yeah, I think this has some value, well, then they can take action upon it. So it really just comes down to the sourcing and the prioritization function as to what is your viewpoint as to the history of data required. Outside of that, I think it's fairly similar.
Thank you very much. I see let's do one quick last question, and then we will end the panel.
Michael, strategically, from a data perspective, how does this game play out? I mean, this seems to be a very heavily fixed cost model where you build the systems over time, and then they create returns as you go. So there's large banks involved, there's large investments funds involved. Is this a scale model? And how do you see that playing out over time?
It's a great question. So when I was at JP Morgan, my budget was huge, and the investment required was huge. The investment that we've done here, Professor Lev would not be happy with us, right? We had to invest before we had the revenues associated with it. We had to think of ourselves as a traditional technology company funded by the co-founder of Renaissance and other people of that caliber, and had to invest millions of dollars in our architecture prior to it. But it's millions instead of hundreds of millions, and that's entirely made possible because of the cloud environment and the fact that we've written all of our code from scratch. So yes, it is an arms race in terms of the technology and the architecture. I can get more into competitive differentiation, but just take it as yes, there is a very high investment requirement to be able to take action in the manner that we do, as well as a expertise requirement to be able to play into that game.
Can open source help there? And what are the better platforms to help, if so?
Open source is incredibly important. In the fact that Python, I think, has pretty much permeated most people's coding languages. Open source has enabled us to be able to apply the machine learning algorithms that Google comes up with in Tensor, and to be able to dive into the actual underlying code and tweak things for our problems to be solved. There is another problem with machine learning, which is that it doesn't care about the bitemporal data problem, which is that, if a company does an earnings restatement, you have to know exactly when that occurred, how do things happen around there. When you're looking at training a machine learning or a neural net to identify cats and dogs, a cat's a dog and a dog are the same. It's not like one day, in this example, an earnings beat is good, sometimes it's bad. That whole contextual understanding as to when timing occurs, that is not yet something that the West Coast has really cared about, but that's where we've been able to add our real value. So yes, open source enables you to stop from recreating the wheel, but you can't just take something out of the box and expect for it to work. But it does help you in terms of the railroad tracks, not just take on burdensome menial tasks.
That's fascinating. Thank you very much. And let's give a round of applause to all the panelists. Thank you.